Prop firms? They promise you funding, huge profits, and the dream of trading without risking your own money. Sounds perfect, right? But what if I told you there's a darker truth? A truth that no one wants to talk about. Escape the 9-to-5, fire your boss. Trade with a six-figure account from anywhere in the world. A laptop, an internet connection, and the freedom you've always dreamed of. This is the intoxicating promise you see plastered all over social media, a constant barrage of luxury cars, exotic vacations, and screenshots of staggering profits. This is the siren song of the proprietary trading firm, or prop firm, an industry that has exploded into a multi-billion-dollar behemoth, promising to turn any aspiring trader into a funded professional, seemingly overnight. They dangle the keys to the kingdom, accounts worth $100,000, $200,000, even $500,000. And the price of admission? A simple, one-time evaluation fee. It sounds like the deal of a lifetime. A golden ticket to the major leagues of trading without risking your own life savings. They sell you the dream of being a Wall Street hotshot without the years of grueling work. But if you're watching this, you've probably felt that nagging doubt. A sense that the slick marketing is hiding a harsher truth. Maybe you've even paid the fee and dove into a challenge, only to find your account disabled for a tiny infraction, leaving you confused and back at square one. You are not alone. In fact, you're in the overwhelming majority. The number they don't put on their homepage is the failure rate. While official figures are guarded like state secrets, industry insiders and data analysts all point to the same shocking conclusion. Over 90%, and in some cases as high as 97% of all traders who attempt these challenges fail. Let that number sink in. For every 10 traders who sign up filled with hope, at least 9 will walk away with nothing but a lighter wallet. This isn't an unfortunate side effect of their business model. For many of the largest firms, the business model. They aren't primarily making money from a share of successful traders' profits. They are generating millions of dollars every month directly from the fees of traders who are statistically destined to fail. It's a churn and burn volume game built on a foundation of broken rules and broken dreams. So what is really going on? Is this just the brutal nature of the financial markets, weeding out unskilled traders? Or is there something more calculated at play? Are the rules of the game, the razor-thin drawdown limits, the ambitious profit targets, the short time frames, intentionally designed to be a psychological minefield? Are they deliberately exploiting human psychology, preying on greed and hope, pushing traders into making the exact high-risk emotional decisions that guarantee failure? In this investigation, we are pulling back the curtain. We will dissect the challenge rules and show you how they are engineered against you. We'll talk to former employees and seasoned traders who have cracked the code. We will analyze the psychological traps they set and reveal the data that proves their model relies on your failure. And most importantly, we'll answer the ultimate question. Is it possible to beat them at their own game? And if so, what does it take to get funded and, crucially, get paid? What I'm about to share could save you thousands of dollars and years of frustration. Stay with me because the story is far bigger than you can imagine. The promise is intoxicating, isn't it? Trade with a 6 or even 7-figure account, keep the lion's share of the profits, and risk none of your own capital. It's the dream sold to millions of aspiring traders across the globe, a shortcut to the major leagues. But have you ever stopped to ask yourself, if they're giving away hundreds of thousands of dollars, how are these firms so incredibly profitable? The answer is unsettling, and it lies in a carefully constructed business model that most participants never fully grasp until it's too late. It's a model that doesn't rely on you winning. In fact, it relies on the exact opposite. Here's the first and most critical truth. The vast majority of a prop firm's revenue doesn't come from a share of profits generated by successful traders. It comes from the fees paid by the thousands who try and fail. These are called challenge fees, evaluation fees, or sign-up fees. Whatever the name, they are the lifeblood of the industry. Think of it less like a trading partnership and more like a high-stakes arcade. The house makes its money not when you hit the jackpot, but from every single coin you put in the machine to play the game. Let's look at the cold, hard math. Industry insiders and community data suggest that the failure rate for these challenges hovers around a staggering 90 to 95%. Now, consider a mid-sized firm that attracts 10,000 new applicants in a single month. If each trader pays an average fee of $300 for a shot at a $100,000 account, that firm has generated $3 million in revenue. That's before a single trade is placed on a live, funded account. That's before they have to pay out a single dollar in profit splits. The business model is front-loaded. The profit is secured the moment you click pay. This creates a powerful psychological loop. When a trader fails, often by a razor-thin margin, their first thought isn't, "This is impossible," but rather, "I was so close, I'll get it next time." The firms know this. They capitalize on this near-miss psychology, often offering discounts for immediate retrees, feeding the hope and encouraging traders to jump right back in. It's a churn model. They don't need a few traders to succeed spectacularly. They need the vast majority to fail, retry, and fail again, each attempt adding to the company's bottom line. The real business model isn't trading, it's selling the dream of trading over and over again. To ensure this high failure rate, the challenges themselves are often designed to be a brutal gauntlet of conflicting rules. They demand you make a significant profit, like 8 or 10%, but they cap your maximum loss at 5%. They give you a tight daily drawdown limit, meaning a single volatile news event can end your attempt in minutes. Some even have rules against holding trades over the weekend or during news events, precisely the times when significant market moves happen. These rules are presented as risk management, but in reality, they create a trading environment so restrictive that it forces you to either trade timidly and miss the profit target, or trade aggressively and hit a drawdown limit. Break just one rule, even by a single cent or a single second, instant fail. No warnings, no second chances. Your fee is gone. So how is this legal? Many of these firms operate in a regulatory gray area by defining themselves not as financial institutions, but as educational companies or competition platforms. You aren't buying access to capital, you're buying a chance to win a contest. The challenge you're trading is almost always on a demo or simulated account. This distinction is crucial, as it allows them to sidestep the strict regulations that govern traditional brokerages and hedge funds. They are selling a product, the challenge, not a regulated financial service. It's a system engineered for failure, built on fees and protected by legal loopholes. They know how traders think. They sell you dreams of quitting your job, making thousands daily. Their ads show exotic cars, jets, freedom, but they use your ambition against you. They keep you hooked on hope that the next challenge will be the one. It's gambling psychology. Let's talk about the moment every aspiring trader dreams of, the payout. Prop firms plaster their websites with testimonials and screenshots of 5- or 6-figure payouts, selling a vision of financial freedom funded by their capital. And yes, some traders do get paid. These success stories are the lifeblood of their marketing machine, the powerful bait that lures in thousands of hopefuls, each paying a fee for their shot at the big time. But what happens when you move beyond just passing the challenge and become consistently, dangerously profitable? This is where the dream can curdle into a nightmare. Buried deep within the terms and conditions you hastily agreed to is a web of clauses designed to protect the firm, not you. We're talking about vague catch-all rules that give them the sole discretion to terminate your account for almost any reason at any time. Reasons like unusual trading patterns or not trading in a manner consistent with the firm's risk appetite. These are often intentionally ambiguous, providing a convenient excuse to cut ties the moment you become a liability rather than an asset. And here is the industry's darkest, most poorly kept secret. The vast majority of these firms are not connecting you to a live market with real capital. Your funded account is, in most cases, just another demo account running on a simulated server. They aren't your partners, they are your counterparty. They are the house. When you place a trade and win, there is no external profit from the market flowing into the system. Your profit is a number that the firm now owes you directly from its own pocket. Think about their business model. Their primary revenue stream isn't a share of successful traders' profits, it's the fees collected from the estimated 95% of traders who fail the challenges. Your success represents a direct hit to their bottom line. So when you start winning consistently, you aren't a star trader they want to nurture. You're a financial drain, an anomaly in a system built on failure. This creates a fundamental, irreconcilable conflict of interest. They need you to believe you can win, but their survival depends on you ultimately losing. Online trading forums are littered with eerily similar stories. A trader we'll call Marco documented his journey. He passed a $100K challenge, followed the rules meticulously for 3 months, and built up over $15,000 in profits. The day he requested his first significant payout, his account was frozen. The reason cited? Gambling-style trading. Despite him never having violated the daily drawdown or max loss rules, his profits were voided and his account was closed. He had no recourse, as the firm operated out of an unregulated jurisdiction. Marco wasn't trading the market, he was unknowingly betting against the house, and the house decided he had won too much. So what should you do? Focus on becoming profitable first, without rushing into challenges. If you can't profit on your own account, prop firms won't save you. Before joining any prop firm, check reputation, read fine print, understand the real odds. Passing is designed to be hard. Now you know the truth. Will you still take the risk, or focus on building skills first? Let me know in the comments below. If this helped you, smash that like button, subscribe, and share with every trader you know. Drop prop firms in comments for more secrets.